It's tax season. You're sitting at your kitchen table, staring at a W-2, doing math you already know the answer to. You worked for 12 months. You missed weekends. You answered emails at 10 p.m. You dealt with stress that aged you visibly. And when you add it all up, roughly 3 to 4 of those months, the late nights, the early mornings, the entire output of that time went directly to the government. You kept what was left, which never feels like enough. Then you open your phone. There's a headline. A billionaire, someone whose net worth increased by $13 billion last year, paid a lower effective tax rate than you did. Not a similar rate, lower. A person who made more money in a single afternoon than you'll earn in your entire lifetime paid less, as a percentage, than the person sitting at that kitchen table with the W-2 and the cold coffee. This is not an exaggeration. ProPublica's analysis of leaked IRS data showed that between 2014 and 2018, the 25 wealthiest Americans paid a true tax rate of roughly 3.4% on their wealth growth. You probably paid somewhere between 25% and 40% on your income. Same country, same tax code, completely different game. And here's the uncomfortable truth that nobody wants to say clearly. The system isn't rigged because the wealthy are breaking laws. It's rigged because they're playing a completely different game, with a completely different rulebook than the one you were taught in school. The rules you learned, the ones about working hard, earning a good salary, and saving what's left after taxes, those rules are real. They're just the expensive rules, the ones designed for people who trade time for money. The wealthy don't trade time for money. They trade money for assets. And the tax code treats those two activities in fundamentally, radically, almost comically different ways. Today, I'm going to break down the exact 3-step mechanism the top fraction of a percent uses to legally opt out of the income tax system almost entirely. It's called buy, borrow, die. And by the end of this video, you're going to understand not just how it works, but why your high salary might actually be a trap, and what the alternative looks like, even if you're nowhere near billionaire status. My name is Andy, and this is Andy Explains Money. To understand why the rich don't pay taxes like you do, you have to understand the fundamental difference between how you get paid and how they get paid. Because the tax code doesn't treat all money the same. It treats different types of money in dramatically different ways. And the type of money you earn determines how much of it you keep. When you earn a salary, that money is taxed immediately. Before it ever touches your bank account, the federal government takes a cut, the state government takes a cut, Social Security takes a cut, and Medicare takes a cut. By the time the direct deposit hits, 25% to 40% of what you earned has already been redirected. You never saw it. You never held it. You just worked for it, and then watched a significant portion of it leave before you could do anything with it. This is what you might call the W-2 trap. You're trading your time for money, and that money is taxed at the highest possible rates the system imposes. Earned income, wages, salary, bonuses, sits at the top of the tax hierarchy. It's the most expensive type of money to receive. The wealthy don't sit in this trap, not because they're smarter, because they've structured their financial lives around a different type of wealth growth, one the tax code treats far more favorably. This brings us to phase 1 of the strategy: buy. The wealthy don't focus on income, they focus on net worth. They take their capital and buy appreciating assets, stocks, real estate, businesses, anything that grows in value over time. Here's the critical distinction that changes everything. When you buy a stock and it goes up in value, you don't owe a single penny in taxes on that growth until you sell it. This is called an unrealized gain. If you buy shares of a company for $100,000 and they appreciate to $1 million, you've gained $900,000 in wealth. The IRS cannot touch that $900,000. It sits there, compounding, growing, building, completely tax-free, for as long as you hold it. This is why you see headlines about billionaires whose net worth jumped by $10 billion in a single year while they paid zero income tax. That wealth increase isn't income in the eyes of the IRS. It's unrealized appreciation. It's paper wealth. And paper wealth isn't taxed until it becomes real wealth, until you sell. So the wealthy don't sell, ever. They let the snowball roll. They let the appreciation compound year after year, decade after decade, with zero tax drag. While you're paying 30% of your income to the government every year, losing that money to taxes and losing the compounding those dollars would have generated, their entire net worth is growing at full speed with nothing siphoned off. The gap between these two approaches, compounded over decades, is not a difference of degree. It's a difference of kind. It's why the wealthy get exponentially wealthier while high-income earners stay on the treadmill. But this creates an obvious question. If all their wealth is locked inside assets, stocks, real estate, businesses, and they never sell anything, how do they actually pay for their lives? How do they buy the houses, the cars, the groceries? If their wealth is just numbers on a screen, how do they convert it into a lifestyle? This is phase 2. Borrow. And this is where the strategy goes from clever to genuinely mind-bending. We've been taught our entire lives that debt is bad, that debt is a trap, that the goal of financial responsibility is to owe nothing to anyone. And for consumer debt, credit cards, car loans, financed vacations, that's absolutely true. Consumer debt will destroy your financial future. But the wealthy use a completely different kind of debt. Instead of selling their appreciated assets to get cash, which would trigger a massive capital gains tax bill, they go to a bank and borrow against those assets. This is called a securities-backed line of credit, or sometimes a portfolio line of credit. Here's how it works. You have a $10 million stock portfolio. You walk into a private bank and say, "I'd like to borrow $5 million. The bank looks at your portfolio, sees $10 million in collateral, and says, "Absolutely. Here's $5 million at 3% to 4% interest." The money arrives in your account. Now here's the part that breaks people's brains when they first hear it. Loan proceeds are not taxable income. When the bank wires that $5 million into your account, the IRS sees nothing. Zero income, zero tax. You now have $5 million in spending power, cash you can use for anything, and your tax liability is exactly the same as someone who earned nothing that year. You didn't sell a single share. Your investments are still growing. Your portfolio is still compounding at 8% or 10% a year, and you're living on borrowed money that the government can't tax because borrowing isn't earning. But what about the interest? You have to pay 3% to 4% interest on that loan. Isn't that expensive? Do the math. Your portfolio is growing at 8% to 10% a year. Your loan costs 3% to 4%. The spread between what your assets earn and what your debt costs is 4% to 7% in your favor. You're making money on the borrowed money. Your assets are growing faster than your debt costs. The bank gave you cash to live on, and your net worth still went up. Compare this to what happens when you earn money the traditional way. You work, you earn $100,000, the government takes $30,000 to $40,000, and you're left with $60,000 to $70,000 to live on. You lost 30% to 40% before you could invest a single dollar. The wealthy person borrows $100,000 against their portfolio. They pay maybe $3,500 in interest. They keep the entire $100,000 in spending power. Their portfolio keeps growing, and their effective cost of accessing that money was 3.5% instead of 35%. That's not a small difference. That's a 10-to-1 advantage, and it compounds year after year after year. This brings us to the third and final phase. Die. I know it sounds morbid, but estate planning is where the ultimate loophole lives, the one that closes the loop and makes the entire strategy perpetual. You might be wondering, if the wealthy keep borrowing and borrowing against their assets, doesn't the debt eventually need to be repaid? Won't the bill come due at some point? Yes, but here's when it comes due and how it gets paid. When the wealthy person dies, their heirs inherit the assets. And under current tax law, something remarkable happens. It's called the stepped-up basis. Let me explain with a simple example. Your grandmother bought stock 50 years ago for $10 a share. Today, it's worth $500 a share. If she sold it the day before she died, she'd owe capital gains tax on $490 per share of appreciation. Decades of tax liability, coming due all at once. But she doesn't sell. She dies holding the stock. And when you inherit it, the IRS resets the cost basis to the current market value, $500. As far as the tax code is concerned, you bought that stock for $500. All the appreciation that built up over 50 years, all the capital gains tax that would have been owed, vanishes. It's erased. It simply ceases to exist. So here's how the cycle closes. The heirs inherit the assets with a stepped-up basis, meaning zero capital gains tax liability. They sell a small portion of those assets to pay off any outstanding loans their parent took out to fund their lifestyle. Because the basis was stepped up, they pay no tax on that sale. The debt is cleared. The family keeps the vast majority of the wealth, and they're ready to start the cycle all over again. Buy more assets, borrow against them, never sell. Pass them on. Buy, borrow, die. It's a three-step wealth preservation machine that legally bypasses the income tax system. The same system that takes 30% to 40% of every dollar you earn before you can do anything with it. This is why dynastic wealth persists across generations. This is why the gap between the wealthy and everyone else continues to widen. Not because the rich work harder, not because they're smarter, because the tax code rewards capital and penalizes labor. If you work for money, you pay the maximum rate. If your money works for you, you can pay close to nothing. And if you structure the transfer correctly, your children pay nothing either. Now, you're probably thinking, this is great for someone with $10 million in stocks, but I can't walk into a bank and borrow against my savings account. And you're right. You can't do this at that scale. Not yet. But the principles underneath buy, borrow, die can be applied by anyone who shifts their mindset from consumer to capital allocator. The scale changes. The mechanics are the same. The first application is the simplest. Stop prioritizing paying off cheap debt and start prioritizing accumulating appreciating assets. Most people are obsessed with being debt-free. They throw every extra dollar at their 3% mortgage or their 4% car loan. They think eliminating debt is the path to freedom. But by doing that, they're trapping their equity inside an asset they can't eat and can't spend. They're killing their liquidity. They're choosing a guaranteed 3% return, the interest saved, over a probable 8% to 10% return in the market. The wealthy person would never pay off a 3% mortgage early. They'd take that extra cash and invest it in index funds, in rental property, in anything that grows faster than the interest rate on the debt. They understand that every dollar used to pay down cheap debt is a dollar not compounding in the market. Over 20 or 30 years, that difference is hundreds of thousands of dollars. The second application is home ownership, specifically how you think about the equity in your home. Most people treat their home like a piggy bank they're trying to fill up. Pay down the mortgage, build equity, celebrate when the balance drops. The wealthy treat home equity as a resource to be deployed, not a trophy to admire. As your home appreciates, you can use a home equity line of credit to access that value, tax-free, without selling the house, and use it to buy more assets. A rental property, an investment, a business. You're borrowing against one asset to buy another asset. You're creating your own miniature version of buy, borrow, die. Using debt to expand your asset base rather than using income to eliminate debt. This requires a fundamental psychological shift. You have to stop seeing all debt as the enemy and start distinguishing between debt that destroys wealth and debt that builds it. Bad debt is borrowing money to buy things that lose value. Cars, clothes, electronics, vacations on a credit card. That's consumer debt, and it will keep you poor. Good debt is borrowing money to buy assets that appreciate or generate income. Good debt, managed carefully, builds wealth. The wealthy carry almost no consumer debt, but they carry enormous amounts of strategic investment-backed debt. They're leveraged, controlling large amounts of assets with relatively little of their own capital at risk. The third application is your investment portfolio. If you have a taxable brokerage account, you can apply for margin or portfolio-based lending. This allows you to borrow against the value of your stocks without selling them. Instead of liquidating shares to cover a down payment, handle an emergency, or fund an opportunity, triggering capital gains taxes in the process, you borrow against the portfolio. Your shares stay invested, your growth continues, and you avoid the tax event entirely. This comes with real risks. Margin calls can force sales during market drops. Over-leveraging can amplify losses. This is not a strategy for beginners or for people without a solid financial foundation. But used conservatively, by someone with a stable portfolio and a clear understanding of the risks, it's a way to access liquidity without triggering the tax drag that erodes wealth over decades. And the tax drag is enormous. If you lose 30% of your gains to taxes every year for 40 years, that doesn't just reduce your final wealth by 30%. Because of the lost compounding on those taxed dollars, it can reduce your terminal net worth by 50% to 60%. The buy, borrow, die strategy is ultimately about eliminating that drag, keeping 100% of your capital working for you, 100% of the time, with zero leakage to the tax system along the way. Let me be clear about something. I'm not telling you to take reckless risks with leverage. I'm not telling you that debt is always good or that paying off your mortgage is always wrong. Context matters. Risk tolerance matters. Your financial foundation matters. What I am telling you is that the mental model most people operate under, earn income, pay taxes, save what's left, try to invest, repeat, is the most expensive possible approach to building wealth. It's the approach that maximizes the government's cut and minimizes yours. And it's the only approach most people are ever taught. The wealthy learned a different approach. They buy assets that appreciate without triggering taxes. They borrow against those assets to fund their lifestyle without selling. And they pass those assets to their heirs with a reset tax basis that eliminates the accumulated liability. 3 steps, completely legal, stunningly effective, and available, in principle if not in scale, to anyone willing to stop thinking like a worker and start thinking like a capital allocator. A worker tries to increase their salary. A capital allocator tries to increase their assets. A worker tries to eliminate all debt. A capital allocator tries to manage debt strategically. A worker sees the tax code as an inevitability. A capital allocator sees the tax code as a roadmap, one that rewards certain behaviors and penalizes others. The tax code rewards capital ownership, asset appreciation, and long-term holding. It penalizes earned income, frequent selling, and short-term thinking. Align your financial behavior with the incentives the system already offers, and you stop swimming upstream. You start moving with the current instead of against it. You don't need to be a billionaire to start. You need to buy your first index fund and hold it. You need to stop selling assets every time you need cash and start thinking about how to borrow against them instead. You need to build a taxable brokerage account alongside your retirement accounts so you have the flexibility to deploy this strategy when the time comes. And you need to understand that every dollar you keep invested, every dollar that doesn't get siphoned off to taxes, is a dollar that compounds for your future instead of funding someone else's priorities. The system isn't going to change. It wasn't designed to be fair to wage earners. It was designed to incentivize capital formation, and it does exactly that for anyone who learns the rules. Now you know the rules. Not the rules they taught you in school, the rules about working hard and saving what's left. The other rules, the ones that were always there, written into the same tax code you've been filing under your whole life, waiting for someone to explain them in plain language. The game hasn't changed. Your understanding of it just did. Subscribe to Andy Explains Money if you want the next breakdown. I'll see you there.